Palantir is no longer a quiet software story. It is the market's cleanest fight between two extremes. The bear case says this is a defense-flavored contractor trading as if perfection is already priced in. The bull case says Palantir is becoming the trusted AI operating layer for governments, shipyards, factories, banks, and the global economy. That is the thesis today: Palantir defense contractor or generational AI backbone.
To make this simple, we're going to separate three questions. First, what has Palantir already proved in the numbers? Second, what is the market already paying for in the stock? Third, what still has to go right for the generational thesis to survive? That structure matters because Palantir can be a phenomenal company and still be a dangerous stock if expectations get too extreme. The point of this video is not blind hype. The point is to decide whether Palantir is still being misunderstood as a contractor or whether investors are already pricing it as the AI backbone before that future is fully proven. This also keeps the video honest. A 10-10 Palantir script cannot sound like a fan letter. It has to show why the numbers are extraordinary, why the stock is still risky, and why the answer may depend on whether AIP becomes infrastructure instead of another software budget line.
Start with the shock number. Palantir reported about $1.63 billion of Q1 2026 revenue, up 85% year over year. For a software company already operating at this size, that kind of acceleration is rare. This is not a tiny startup tripling off a low base. This is a scaled public software company suddenly growing like demand moved into another gear. That is why the quarter changed the debate. Bears can still attack valuation, but they can no longer say the business is slow. Bulls can point to a simple fact: AI demand is not just showing up in headlines. It is showing up in revenue, guidance, and customer expansion. The reason this matters for retention is that the viewer immediately understands the scale of the moment. This is not a vague AI story. It is a company converting AI urgency into actual reported dollars. When a company this large accelerates this hard, every old valuation model has to be checked again.
The best fundamental argument is Palantir's Rule of 40 score. In software, the Rule of 40 adds growth and profitability to measure whether a company is growing in a healthy way. Good companies want a clear 40. Palantir posted 145. That means the company is not choosing between growth and margin. It is showing both at the same time. Revenue growth is explosive, adjusted operating margin is extremely high, and adjusted free cash flow remains strong. This is the part that separates Palantir from the old software playbook, where companies bought growth with losses and promised profits later. That is why this chapter should be visual. Show a simple scoreboard. Growth on one side, margin on the other, then the combined 145 score. The audience does not need accounting complexity. They need to understand that Palantir is currently doing the thing most software companies only promise: growing fast while printing strong costs, scaling better.
The old bear label was simple. Palantir is just a government contractor. Q1 2026 makes that label too small. U.S. commercial revenue reached about $595 million and grew 133% year over year. That is the new engine. Enterprises are not just testing AI in a lab. They are putting Palantir into workflows where data, permissions, decisions, and operations have to connect. At the same time, U.S. government revenue was about $687 million and grew 84%. That is the anchor. So the story is not government versus commercial. It is government proving trust, security, and mission-critical credibility, while commercial proves scale, adoption, and a much larger market. This chapter should feel like a split-screen reveal. On the left, government command centers, defense workflows, and secure data. On the right, enterprise dashboards, factories, banks, and commercial operating rooms. The payoff is that Palantir's story is no longer one engine pulling the stock. It is two engines, and both are accelerating at the same time.
This is where the narrative changes. A traditional defense contractor sells hardware, services, integration work, and long procurement programs. Palantir is trying to sell the decision layer across those systems. Its AIP pitch is an AI no-slop zone, not a generic chatbot that hallucinates, not a flashy dashboard that looks good in a demo, but a controlled environment where AI works with permission data, audit trails, business rules, and real operational actions. That is why the defense contractor label misses the point. Defense may be the credibility base, but AIP is the platform attempt. Use this as the old label to new reality transition. The old label is contractor. The new claim is trusted AI infrastructure. A contractor gets paid for projects. A backbone gets embedded into how decisions are made. That difference is exactly why bulls are willing to underwrite a bigger total addressable market.
The strongest proof point is not a sales slogan. It is the submarine planning example. In Navy shipbuilding pilots, General Dynamics Electric Boat cut submarine schedule planning from roughly 160 manual hours to under 10 minutes. That is the line viewers should remember. This is AI moving from presentation software into heavy industry. Picture a gritty shipyard, steel, supply constraints, labor bottlenecks, maintenance schedules, and production pressure. Then put an AI workflow layer on top that compresses days of planning into minutes. That is the generational argument in one image. Palantir is most valuable when the data is messy, the stakes are high, and the answer has to change the physical world. Visually, this should be the most memorable scene in the video. Do not show only server racks here. Show shipyard floors, welders, submarine hulls, planning rooms, procurement boards, and AI overlays connecting production tasks. This is where the audience feels why Palantir is not just selling software into screens, but into bottlenecks that affect national capacity.
The easiest AI tools sit on the surface. They summarize, draft, search, and answer questions. Those tools can be useful, but they're easier to copy. Palantir's moat claim is deeper. The company wants to become embedded inside the customer's ontology, security model, data pipelines, operating rules, and decision loops. Once a platform is connected to how an organization actually works, ripping it out becomes harder. That does not make the moat automatic. It does mean the moat is not just model quality. It is trust, deployment history, integration depth, and operational proof. The strongest version of the moat is compounding context. The more Palantir understands a customer's data map and operating rules, the more useful the platform can become. That creates a possible flywheel: faster deployment, deeper workflows, more use cases, larger contracts, and a harder replacement decision for the customer.
Now the bear case has to be taken seriously. Michael Bay's argument is not that Palantir has no product. The sharper bear case is that the stock is already pricing in a nearly flawless future. Bears worry that AI excitement is pulling demand forward, that customers may spend aggressively now and normalize later, and that the market is rewarding adjusted metrics too generously. This is the real danger with Palantir. A company can be elite and the stock can still punish buyers if growth decelerates from extreme levels. In high expectation names, the enemy is not failure. The enemy is normal. This is where the video earns credibility with skeptical viewers. A high-quality company can still be a bad entry if the market has already priced in too much. The danger is not that Palantir suddenly becomes irrelevant. The danger is that the stock needs extraordinary results just to hold its multiple.
The bull case is just as clean. Kathy would buying the dip represents the opposite view. Palantir may look expensive because the market still does not fully understand the platform shift. Bulls argue that the company is not selling a single AI feature. It is selling a control plane for applied AI. Wall Street upgrades and higher revenue expectations add to that argument because the estimate path is still moving up. This is why the tug-of-war is so powerful. Bears are looking at valuation. Bulls are looking at category scarcity. Both sides can sound rational at the same time. For the bull, the question is not whether the current multiple looks high on a spreadsheet. The question is whether the spreadsheet is using the wrong category. If Palantir becomes the default AI operating layer for high-stakes institutions, then the market may keep paying a premium for scarcity, trust, and speed of adoption.
This is the chapter that keeps the video credible. Palantir is priced like a company that must keep delivering elite growth, elite margins, and elite execution. That means the stock can fall even when the company reports good results, because good may not be enough. A premium valuation is a contract with the market. Every quarter has to prove the story again. Revenue growth has to stay hot. Commercial adoption has to keep expanding. Margins have to hold. Deal value has to back up the hype. If those pieces weaken, the multiple can compress fast. This is why every Palantir rally can feel euphoric and every sell-off can feel brutal. When a stock is priced for greatness, the market does not grade it like an average company. It grades it like a company that has to keep proving it belongs in the rarest tier of software and AI infrastructure.
The backbone case breaks if Palantir starts looking like a normal software company again. Commercial growth could slow after the first AI adoption wave. Government demand could remain strong but not large enough to justify the broader platform valuation. Competitors could package easier AI products that pressure pricing. Implementation complexity could limit how fast new customers scale. Stock-based compensation and adjusted metrics could become a bigger debate if investors lose patience. The bear case does not need Palantir to collapse. It only needs the company to stop looking exceptional. This chapter should also avoid strawmanning the bears. The most dangerous bear case is not that Palantir is fake. It is that Palantir is real, but not real enough to justify every dollar of expectation embedded in the stock. That is a much stronger and more useful warning for viewers.
Here is the watch list. First, total revenue growth, because that tells us whether the 85% acceleration is durable or peak momentum. Second, U.S. commercial growth, because that is the biggest narrative engine. Third, U.S. government growth, because that is the trust anchor. Fourth, remaining deal value, because it shows whether demand is becoming backlog instead of just excitement. Fifth, adjusted operating margin and free cash flow, because the magic of this story is growth plus profitability. If those five stay strong, the backbone thesis gains proof. For visuals, make this a clean dashboard. 5 tiles, 5 metrics, no clutter. Revenue growth, U.S. commercial, U.S. government, remaining deal value, and margin/free cash flow. Then add a 6th smaller tile for real-world AIP outcomes, because the story needs proof beyond finance metrics.
The bull case says Palantir becomes the operating system for applied AI. Defense is the beachhead. Commercial is the expansion engine, and AIP becomes the layer that turns enterprise data into decisions. The bear case says the company is excellent, but the stock is priced for a flawless future, so even strong numbers may not protect the multiple. The base case sits in the middle. Palantir is a real platform with rare growth and profitability, but the stock remains violent because expectations are extreme. That is the balanced answer. The business can be generational while the stock remains risky. That is the tone the audience needs. Not blind bullishness and not lazy bearishness. The stock is a battlefield because both sides are reacting to something real. A company with exceptional momentum and a valuation that punishes any sign of normalizing growth.
Final verdict. Palantir is no longer just a defense contractor. The commercial acceleration, government strength, rule of 40 score, and real-world industrial AI examples have earned it a bigger frame. But generational companies do not win that label from one quarter. They earn it by proving durability through multiple cycles. Ultimately, deciding whether Palantir is an AI backbone or an overvalued contractor is up to your own research. This breakdown is purely educational, not investment advice. But one thing is clear: Palantir has earned the right to be studied seriously. That line keeps the ending strong without sounding like advice. The viewer leaves with a framework, not a buy or sell instruction. The thesis stays clear. Palantir has moved beyond the contractor box. But the market is demanding that the AI backbone story keep proving itself in numbers and deployments.